I got a question from a YouTube viewer who says, David, explain equity. The guys on Shark Tank are always saying they're going to give a certain number of dollars for a certain percent of the equity in a business. What is that all about? Hey there, everyone. It's David Barnett from davidcbarnett.com, the blog site, YouTube channel, iTunes, SoundCloud, Google Play, Stitcher, podcast where I talk about buying, selling, financing, and managing small and medium-sized businesses. I've got my whiteboard back. Contractors are done. I'm in my new studio. Very excited to be here. Very excited to start answering some questions where we have to draw stuff out on the board once again. So, on to track. Thanks for your question on YouTube. And let me just pause and I'll draw something here on the board. All right, I drew out a simple balance sheet. And a balance sheet is one of our basic accounting statements. And the reason it's called a balance sheet is because it always equals one side to the other. And on one side we have the asset. So in this case, we're going to say it's a widget, it's an object, it's something that we bought for $1,000. And in order to get the widget, what we did is we borrowed at the bank, and the banker was willing to lend us 75% of what the widget cost. So that's why we have this L. This is a liability. So we owe the bank $750, and the rest of the money we put in. And this is the equity, okay? So the equity is the amount of the business or the widget or the object or the thing that the owners own free and clear of the liabilities. So we're getting pretty basic here. I mean, this is way back in the beginning kind of stuff, but it's important for us from time to time to get back and look at some of these things. So when somebody owns a business, let's say, they can acquire a bunch of material, inventory, have cash in the till. The assets are going to be a long list of different things. And there's going to be current assets, things that like cash and inventory that are going to be turned into cash within a year. And there's going to be long-term assets, maybe real estate, machinery, equipment, that kind of thing. And as things come and go and things are bought and sold, the value of those assets is going to be fluctuating all the time. Over on the other side, we've got liabilities, and liabilities can be bank loans. They can be what we owe suppliers for goods that have been delivered that we haven't paid for yet, etc. And then the balancing amount is our equity. And the equity comes from a bunch of different places. So the equity can come from people putting money in to start a business. And if a business has been going for some time, equity can also be coming from past profits that have been left in the business. And we'll sometimes see a line in the equity section of a business that says retained earnings, and that's what that is. It's money that we earned in the past that's been kept within the business. Now, you brought up Shark Tank. So let's talk about that. Because in an episode of Shark Tank, if someone presents a really great idea, those sharks are going to be making offers. And as you're going to see when we talk about this, for someone who's involved in buying and selling and valuing businesses, some of these conversations can be a little high level, and you'll realize there's a whole whack of assumptions that have been thrown into those comments or bids that really have to be sorted out. And I once saw a special, sort of a behind the scenes of Shark Tank, and this was one of the things that was addressed, is the fact that, of course, all of these bids are subject to due diligence. The sharks are going to investigate all the claims that were made. They're going to make sure the patents were filed. They're going to make sure that, are there debts, etc., right? So basically what the shark is saying when he says, I'll give you $100,000 for 10% of the equity, is they're talking about the ownership of the shares, okay? And in a lot of these startup businesses, one of the assumptions that's made is that there is no long-term or significant debt that's already in the business. That the business is pretty much assets and equity. Usually the people, the entrepreneurs that present to a show like Shark Tank have invested their own money into the business to get things going, to make their prototype, etc. Some of them may have retained earnings because they've already got sales going on. So they're talking about a percentage of ownership. So in some of my other videos, I talk about shares in a business. There's one video in particular, should my business have 100 or 1 million shares? So the equity is basically a balancing entry between what the business owns and what the business owes. But the ownership of that equity, this is divided up into little pieces called the shares. Okay? And here's where it gets interesting. Because the number of shares outstanding or the money that somebody put in may in fact have no resemblance whatsoever to the actual number in the equity section of the business. So for example, I could invest, $1,000 in creating some new technology, and then I go and present it to the sharks, and they believe that my new technology is worth $1 million. So they want to buy into my company, and they say, David, we'll give you 100 grand for 10% of the equity of the business. And so what they're saying to me is that they're willing to pay $100,000 to own 10% of the shares. Okay? There's not going to be $1 million in here, right? It's not going to happen. What's going to happen in here is there's going to be whatever equity that I put into the business to develop the technology. And in saying that they're willing to give 10% or $100,000 for 10%, what they're saying is that the equity, the shares of ownership of this business, is worth $1 million in total. Okay. The other thing that is not quite clear when the sharks are making their pitches is that typically if I owned a business and you said, I'll pay you a certain amount of money for a percentage of the business, typically that buyer would be giving the seller the money. So they would be giving me the money for the shares. And that's not what happens in Shark Tank. The second big assumption that happens in Shark Tank is that the money is going to go into the business. And the shares that the shark are going to get are going to be newly created shares. So they don't want the entrepreneur to walk away with their money. They want the money to go into the business, actually inflating the assets, because the cash is going to go in there. And they're going to make the business worth more by putting some of their money in. Okay. The third big assumption, of course, is that everything presented is accurate and real. And I know that if you go online and start looking up, where have they been, what has happened kind of shows, you will find that some of the deals that end up being done by people like Sharks and Shark Tank, or there's Dragon's Den shows in Canada and the UK that are similar. Sometimes the deals don't actually end up being quite what was offered on the show, and that's as a result of the dragons or sharks doing this finer due diligence when they get into things. So the value of a business, of course, is related to cash flow. And if you had a business and you looked at it and you found what the equity was worth, we call that book value, because it's the value of the equity on the books of the company. And very rarely is the book value of a business equal to the market value of the equity. So let me give you an example. You could put millions of dollars into building up a business and have equipment and machinery, and you're never able to make a profit because you can't quite figure out how to make the widgets at a low enough cost, and people won't pay what you need them to. And so you invested a bunch of money. Your business may have a book value that's quite significant, but the market value of that business could be nothing because it doesn't make any money. These are some of the things that we get into when we're talking about business valuation. And for someone who's new at this, it can be something that is difficult to get your head around, but just keep watching the videos and keep asking the questions, and I hope that I can help you out. Remember, if you found the video useful, then you should be clicking like and you should be sharing it. One of my missions is to help educate people so they don't get taken advantage of, whether they're a buyer or a seller, by someone who's going to, try to take advantage of ignorance. And so if you want to help me protect people from unscrupulous types, the easiest way to do it is to like and share, because it shows YouTube that the video content is good. And if you want to make sure that you don't miss any of my content, then you need to subscribe to my email list over at davidcbarnettlist.com, and you'll get my new videos every Friday, as well as all the other thoughts, ideas, and comments that I send out from time to time throughout the week. And with that, we'll say thanks, and we'll see you later. Bye. So what do you think of the new studio?
I think it's really cute, creative.
Yeah. I like it. I find it very efficient because I get to share it now with the washer and dryer.
Yes. Well, I mean, it's short term.
Yeah.
It can be.
Yeah.
It's cute though.
Yeah. I don't think anyone really realized how tall you were.
Yeah, I'm a little tall. Okay, we'll have fun.